by having a good, capable, competent team who's got, great experience doing this, being able to manage that construction project. We've got great project managers that are experienced at this. That's a big part of it, right? We've done five of these already. We built them, we manage them. So that experience, I think, in and of itself, helps us mitigate risk, certainly.
Welcome to the Path to Passive podcast, where we talk about building wealth and empowering lifestyle through commercial real estate investing for tech professionals. I always wish that other tech professionals reaching financial freedom had documented their journey along the way, so I'm doing it for the rest of us. Join us as we explore stories, many failures, and lessons learned along the way. I hope you enjoy and subscribe. Welcome to another episode of Path to Passive, real estate investing for tech professionals. Today, my guest is Ryan Watts from Red River Development. Super stoked to have you here. Ryan, checking out just your company, the site. You guys have just about 1,500 units under management and almost 500 million assets under management. Dude, that is outstanding. Welcome to the show. For the listener to get to know you a little bit more, tell us a little bit about yourself and how you got into real estate.
Yeah, absolutely. Thanks, Stephen. It's great to be with you. In terms of my entry into real estate, I started real estate investing actually in college. I was buying rental homes and, doing direct kind of management of, single family rentals. Actually started my career in the oil and gas business, had an oil and gas investment firm, sold that company in 2020. And, during, let's say 2018, 2019, was doing multifamily investment with my brother who had a development company based in Tulsa, Oklahoma, where we grew up.
Mhm.
And it was myself and then my other partner in Red River is a guy named Dempsey. So Jay's background is senior living. He's got a large senior living company called Civitas Senior Living that he founded about 10, 12 years ago. They have 38 senior living communities across the country, but primarily in Texas. And so Jay and I were investing with Steven in some projects that he was doing in Oklahoma. And then we were talking about during that time, talking about the build to rent space and the fact that we really believed in this kind of subsegment of multifamily, felt like there was a lot of room to grow in that industry and to build a company around that, and we had conviction that we wanted to invest behind that asset class. So we formed Red River Development to do it. And fast forward to today, here we are, close to 500 million in AUM and about 1,500 units, as you said. So looking to keep growing. So it's been a fun business to build and, an exciting space to invest in.
Yeah, super cool, right? It's always good to, I think, invest with family and good friends. All of you guys based out of Oklahoma. I heard you talk a little bit about that in some other research, some other episodes you were talking on as well.
Yeah,
Always good to get to know you a little bit more and get to know my guests a little bit more too.
sure.
And so you're talking about going from oil and gas. I mean, I love that I heard you were, mowing lawns. You had like 4 properties. You had about 8 doors while you were doing this. And then it sounded like you got into professional career while you were doing oil and gas and still looking at some stuff with, multifamily. Now, was that, multifamily, were you doing like some like limited partnerships, LPs on the side while you were in your professional career? Like you obviously had those properties, so your brain was in real estate while you're developing your career. What was your mindset there too? And before you
Sure.
answer, let me kind of need some context. Is that many of the listeners here are, you know, definitely accredited investors, right? In the tech space, the Amazon, Netflix, Facebook, Google, et cetera. And
Mhm.
they're thinking about, keeping the career, but also making investments. So that's why I'm particularly curious where your headspace was around this too.
Yeah, sure. No, it's a great question. So like a lot of folks, I was doing the same thing. This was right out of college. I was, 24 years old. And even during college, I bought a few rental properties and was working full time at an oil and gas firm at an exploration and production company, actually called Chesapeake Energy, and was living in Oklahoma City and just kind of doing this on the side. Typical, mom and pop.
Hustling.
I had no mom, just me, but so just pop and yeah, doing mowing lawns and collecting rent checks and doing taking care of maintenance and the whole thing and just kind of doing both.
Dang.
And then as my career evolved, I ended up starting a company, moving to Dallas, So those, and then I hired a management company that kind of managed those assets on a third party basis, and I really got focused on that oil and gas business, and really didn't have a lot of space for real estate investment and managing property in Dallas. I was
Yeah.
just consumed with the business. And then later on, as I said, as my brother kind of got off, he was working for a development company in Tulsa. He started a business, was doing some real estate development on his own. So in those deals, I was really just a passive LP, and he was
Right.
running everything, right? So that was passive investing for me. But then, as the opportunity developed, and then I had the opportunity to sell my other business, it created some space for me to really focus full time
Mhm.
on building and growing Red River Development, which has been a lot of fun.
Yeah, yeah, certainly. Super cool. And so you already had some experience with the single family homes, and so your brother was doing some development. And so it sounds like the bridge you know, of going from single family home to investing in apartments or multifamily, that was a pretty small bridge. And the reason why I ask is, sometimes that epiphany of going from, single family to, oh, I can do multifamily. I know
Yeah,
for me it was like, the skies parted for a minute,
yeah.
and so was that it was pretty obvious. I mean, you had trust in your brother telling you about this too. Is
Yeah, I think a lot of it is just having good partners, and that's certainly, I think, what enabled me to kind of make that jump.
Mhm.
I've always been an entrepreneur, building businesses. The finance component of it, capital, the capital component, it was comfortable for me. But yeah, I was fortunate to have Steven, who's got a great background in construction and project management, and we had the basics of a property management business that we've kind of since grown and scaled.
Mhm.
So having him, being able to really have a great handle on that part of the business was super helpful. And then certainly Jay, with his background in doing a ton of ground up development on the senior living side. The three of us together, I think, have a lot of complementary skill sets, but each person kind of has their own,
Yeah.
individual focus, and I think putting that all together is really what enabled us to build and scale a business like we have.
Yeah, yeah, great call. Partners, I mean, that nugget alone of like not only should you not do it all yourself, but it's better when everyone works on their strong point. And so I think that's kind of a good pivot here too. You know, thanks for giving us a bit about your background, your story, and a good pivot into talking a little bit more about Red River and what we're here for, some real estate, right? So,
Yeah,
you know, there's something you like talked about, which is combining the best of A class apartments to really. Well, I'll let you say it. What is you know where I'm going with this? So tell me a little bit about this build to rent asset class.
absolutely. Yeah. So for us, with our BTR brand, which is called Trullo Homes, if you
Mhm.
look up Trullo Homes, you'll see all of our communities. That's how we branded our BTR communities, and that's sort of also our property management business, how we refer to that. And so with our Trullo residents, we're really trying to give them the best of both worlds between a suburban rental home and a new built Class A multifamily community. So we want the amenities of that multifamily community. So we've got a great pool, large clubhouse with community spaces. We've got high end fitness center, 24-hour fitness center, dog parks. All those things. We have on-site maintenance, on-site leasing, so all the maintenance is taken care of. Nobody's mowing yards. I mean, we kind of handle everything. And then on the rental home side, these are unattached,
Mhm.
single story. They live like a home. You're walking to your front door, nobody above you or below you, or and then you have your own private backyard. So you get a lot of the benefits of that suburban rental home, but you also get the benefits of the amenity set of a multifamily community. So that's what we're trying to deliver for our Trullo residents.
Yeah, and I think one of the other things too is they oftentimes will have their own parking garage or surface level parking, whatever, depending on the property, but be able to go from their car directly to their home too, right?
Yeah, yeah, that's right, that's right. Yeah, you pull up. We've got garages for rent. We've got covered parking, or if and both of those, obviously, we're charging a fee for. But if you just want to do surface parking, pull up right by your front door, walk to your front door. It's makes it very easy versus hopping in an elevator maybe,
Right.
moving around a parking garage. None of that with our Trullo communities.
Yeah, I love the way, I think, it was your other host, Chris, that was had said it this way, and it makes so much sense, especially if you're listening and trying to visualize this. It's kinda like that you would have a multifamily, apartment complex, but horizontal, right?
Mhm.
And that made a whole lot of sense to me, is especially as you're explaining these different units. I think you said something like 12 to 16 per acre or something, right?
Yeah, yeah, close to 12 typically, 11, 12, depending on the characteristics of the land and so forth. But the that's typically the density, and yeah, that's a good way to think about it. It's kind of, and it's sometimes referred to that way too, horizontal multifamily. Where you're really just kind of deconstructing an apartment complex. It's sort of, we're less dense than an apartment complex, but
Mhm.
there's more green space. It definitely feels more like a home than it does an apartment complex.
Right. You have your own area, your own backyard, your own parking. So that makes a lot of sense. And we're talking one bedroom, two bedroom, three bedrooms as well, right? Just each
Yeah,
individual units.
that's right. Yeah, so we offer those three unit types, and it appeals to different kind of residents. We've got really our largest demographic is probably young professionals that are transitioning out of apartment living. Maybe they've got a pet, maybe they're starting a family. They don't want to be in an apartment anymore for a variety of reasons. They want something that lives more like a home, but maybe they're not ready to buy a house yet. For whatever reason. So we see a lot of those folks, and then on the other end of the scale, we see a lot of folks that are, maybe they've raised a family in a suburban community, they've sold the house, maybe they're moving to be closer to their kids and maybe grandkids, and they want something that all the maintenance is taken care of. They can lock it and leave it, and maybe they want a larger unit. They've got more stuff, the three bedrooms, something like that. But it gives them great flexibility, and they're still very active and not at the stage where they want to be living in a senior living type community. So we think it's and there's folks all in between, that, but those are two of the biggest demographics that we see, and feel like it's a product that appeals to a lot of folks.
Yeah, I remember talking to you before, and some of the expertise that you have. I think it was Jay. You were talking about senior living
Hmm.
communities, that experience he's had, and then if your brother, even with the development, kind of seeing the trends, like you're talking about some
Hmm.
of the trends and some of the the resident demographics who'd be interested in that
Yeah.
too. But it's kind of a I thought it was a cool almost skill stack. The partners bring their expertise too, of having the idea of what the community should look like for many senior living, but also the development for multifamily that's quote unquote horizontal, and kind of bringing that together, right?
Yeah,
um
yeah, absolutely. And that was one of the things. That's a great point. I mean, when we were talking about build to rent and talking about the idea of starting this business, Jay brought up the fact that in his senior living communities, his most popular product and the one that stayed the most full were really kind of cottages. They had small, oftentimes duplexed homes that were in their senior living communities, and those were really popular with the residents. They're not there really weren't any amenities. They were just, it was just a rental home, but there was a
mhm.
little bit of a premium associated certainly with that, given that it was a senior living community. So the folks were a little bit older, but that those always stayed full, and that was one of the things that we saw as we were talking about this space that was an indicator of what we felt like was a lot of demand out there for a product like this.
Got it. What were there any other? What are some of the other external signals? I'll say nationwide, or we can talk nationwide first, and then I'll ask. We can go into how you guys pick your markets, what markets you're in, and then some
Yeah.
exciting new development stuff that's coming up as well. That's pretty close to me here in Texas, and pretty close to you too. We can talk about. But what are some of those external signals, right? That is sort of validating that BTR was is the right thing. We can call it trends, I suppose.
Yeah, yeah. Well, I mean, the big sort of fundamental trend is, something that your listeners have probably heard before. We have a big housing shortage in the United States, and we don't build as many starter homes as we used to, and the cost of home ownership is a lot higher than it used to be, right?
Mhm.
So, principal and interest on a median priced home in the U.S. is pretty close to 3 grand, a
Yep.
month, principal and interest, and then that doesn't even talk about the carrying costs of insurance and maintenance and all the things that come along with owning a home. And our rents depend, are very depending on market, but we're in the neighborhood of 2,000 a month, and so that's a pretty good value proposition for a lot of folks that maybe don't want to be spending 4 or 5 thousand a month and have something that can give them a lot of the benefits of living in a home. So I think that's a fundamental driver of just people want more options in housing, right? And this
Yep.
is versus just a standard apartment complex or maybe a rental home that's managed by a mom and pop landlord that's 40, 50 years old and just doesn't really have a lot of the benefits of new construction
Right.
or the amenities, right? So I think the demand for that kind of product has been proven out. You saw it start to get built. Initially, it kind of got built in the Phoenix market and then kind of grew out from there.
Okay.
Um, so for us, we saw a lot of that happening. I'm in Dallas. My partner Steven is heads up our office there in Tulsa, and we saw that a lot of investment was happening in the Dallas market, in the Phoenix market, Austin market, and we felt like it was getting a little bit oversaturated. Now I still think there's room to run, but we that plus all the multifamily that was getting developed there, we said, hey, let's go be a first mover or a fast mover in what we think are strong secondary markets, like
Hmm.
Tulsa, Oklahoma, like Oklahoma City, Kansas City, Bentonville, Arkansas, Indianapolis. And so we have communities in all of those markets. And, I think by being a first mover, we've been able to have a differentiated product, be able to push rents probably in a greater way than you can in a
Hmm.
market like, Phoenix or Dallas,
Yep.
where there's a lot of downward pressure on rents in the present time. So that's kind of how we thought about it. And then, once we look at a bigger, broader market, we've got a set of demographic criteria that we really hone in on, things like household growth, income growth, median incomes, in rent to income ratio, household occupancy, home values, school system, kind of
Hmm.
proximity to job centers, things like that. So we want to see those higher than national averages when we kind of get down to the micro,
Hmm.
or the individual location. And so we're always benchmarking those investment criteria, against our other communities and being able to kind of compare that data set. So that's just overall kind of how we think about it.
Got it. So there's definitely looking at all the I mean, a lot to unpack there, right? But some really great nuggets. But in general, taking a look at the macro, again, you mentioned things like, housing shortage. Of course, there's supply and demand there. You talked about the average of about 3,000 or so just in, upfront cost, right?
Yeah.
Not to
Yeah.
mention, like you said, the invisible cost of maintenance, and everything else that comes with, the great things of having home ownership, and that might take your time as well. But on the other side, there's almost the we'll call it the social drivers too
Hmm.
of that in between, right? Of
Hmm.
not wanting to be in an apartment and doing the elevator or all that other stuff, but able to drive up to your own place, having your own unattached unit, and be able to, have that quote unquote home like feel as well. And then you're talking about being a first mover in, on a more macro market level. First movers kind of looking at where is it almost like is path to progress a fair statement as well for those markets?
Yeah, yeah. I think those markets have experienced all have experienced good growth, steady
Mhm.
growth. They're all in business friendly states. They're seeing strong in migration. Now they may not be getting the headline numbers of a Phoenix or a Dallas. Or an Austin, but I think they benefit from the fact that they're also not as competitive. There's not as much capital trying to flow into those markets, and
Sure.
so I think it creates the opportunity to find, hey, more infill sites that are maybe better locations in a market like that, and not as much competition from a
Mhm.
comparable product standpoint.
Perfect. Yeah, I appreciate that second part. Just wanted to kind of expand on first mover because we know what that means. So getting in there, just like it sounds, but what that actually means. It's like first mover, you
Hmm.
get in there, but more the so what aspects, like you said, less competition, more ability to have that rent growth because it's a continuing to grow area and business friendly too. So
Yeah.
Cool. So gives a good picture to a listener of what we're talking about BTR, that sort of horizontal platform, the hybrid of the apartments and the luxury single family type of rental. Let's talk about what this actually looks like, right? So this is Red River Development. You guys do the development, and talk to me about from picking the sites to the shovel in to the timeline to the first dollar in, right, or first resident in, a little bit of both. I mean, coming from a human perspective, but also from an investor perspective, right? And so
Yeah.
talk to me a little about what that looks like.
Yeah, great question. So for us, I talked about how we pick markets, right? And so let's, when we find a site that meets our criteria, we're going to go put that land under contract. And
Hmm.
oftentimes, really in every case, we have to do some kind of zoning work. So that means we're working with the local municipality, whoever that may be, and trying to, either rezone a piece of land for our use, or
Hmm.
maybe we're taking a piece of land that's entitled for multifamily, but most zoning in the US is not entitled for this. There's not a specific zoning designation for this type of product. So we've got to kind of go through whatever that process is locally to be able to build what we want to build. And so then we've got to, design it. So we've got design and architecture, civil design. So we're doing that work, and then really, as we march towards getting that all finalized, we're working with a general contractor. Typically, it's a third party general contractor where we've got a guaranteed max price contract. We're giving them the plans. We're saying, hey, this is what we want to build. We agree to that fixed price, and then we go about capitalizing the deal. So we're sourcing bank debt, typically 65% loan to cost bank debt, working with large regional banks. We worked with variety of banks, and then raising capital from equity investors to build and develop the project. And so then once we do that, we take that piece of land that's shovel ready, and we bring in the capital. Then we break ground, put a shovel in the ground, and then the plan is 14 months later, we've got the first phase of units delivered. And so we build these things in phases. You've got about month 14, you're getting that clubhouse, and you're getting the first, call it, 15, 20 units and the model unit, and you're out, really kicking off your lease, your lease up. We're doing pre-leasing before that, but the lease up really starts to speed up at that point. Once, because people want to be able to, our
See it.
residents want to be able to look at it, touch it,
Yeah.
feel it, really
Hmm.
understand it. Sometimes we're a first mover in these markets, so they don't,
Right.
hey, what is this? What
Right.
is this really? What is built to rent? What does a rental home community look like?
Yeah.
And so they, once that gets delivered, then all of a sudden things really kick up, and then by about month 23, we want to be done with construction. Have the last homes delivered. So we'll have anywhere from, call it, 6, 7, 8 phases, and so we're building it kind of front to back,
Hmm.
trying to minimize impact on the residents that are living there during the time of construction. And then once we're done at month 23, hopefully we're leased up in the next 6 to 8 months. So call that around month 30 or so. And then at that point, we want to start making distributions to our investors. And so we would expect that at that point, we could deliver, high single digit to low double digit yields, cash on cash return there for the equity investor. And then we're going to continue to hold that. The plan would be to hold that and to grow NOI, kind of, increase rents, get the get the community to where it's really, performing well, and then look to exit at the end of year 5, and return everyone's original investment, and generate the remainder of the return there.
Yeah, awesome. Yeah, it's a great call, right? The first, making sure that in that first phase, the model especially is done, because being a first mover, most people may not be even familiar with what build to rent looks like. So from breaking ground, basically, well, to the first phase, about the 14 months, and having those couple, first, I think you said around 14 or so, and then starting to do that lease up. Working with the you mentioned something interesting there, is working with any municipality, city, local government can be really slow, and not having things zoned for something like build to rent. What does that look like? Like, we don't have to go super deep into it, but I'm sort of curious just on the perspective of like, is it because build to rent is only like 5 years old, right? Or so, is it really difficult to get these things rezoned? Is that like a
I mean, yes, it's certainly an issue, and we've had deals that where we had land under contract and we've had to drop it because we couldn't get the city to agree to give us the zoning. And that could be because local residents didn't want it. I mean, there's a certain amount of it's a newer product type. Anytime you talk about rental, sometimes surrounding homeowners, there can be kind of a NIMBYism
yeah,
aspect where people say, "Hey, look, oh, that scares me." We're talking about rental property in the area. Well, hey, is that gonna drive down my home values and all these things that people say, which it does not certainly, but that's some of what you deal with when you're talking about zoning land for this kind of use. And so, yeah, it's an issue, but oftentimes we've seen communities say, "Hey, look, this is great. Our residents want more rental options, and this is something that we don't have today. And hey, this is not we're not you're not building a 3-story apartment complex. These are single story, and it looks
right.
looks a lot like a neighborhood. I mean, hey,
Yep.
that sounds great to us." And so, that's where you're dealing with that you know zoning and an education campaign and
Right.
trying to really show people what the product is. But to your original question, yes, there's not an off the shelf zoning for this typically because it's a newer product type. Almost all municipalities have a multifamily zoning, but that's just a
Hmm.
3-story apartment complex, right? High density apartment complex. And so this is different than that. And for a lot of communities, it's something that you've got to kind of go through what's called a PUD process, planned unit development, that
Yep.
kind of gives you a very specific zoning for your exact use, and that's
Yeah.
that's what we find a lot of times that we're doing.
No, that's cool. That's cool. I was sort of curious in that. I've invested in some new developments as well. And so I was wondering how that was working out. I mean, every listener in here understands that, anything that's new development, new technology, it goes through its phases of, we have to go through this X amount of time before it uh catches on for the government, which is always the fastest. But you know,
Yeah,
but the benefits are there for the residents and for the community, looking community like. So like I said, it's definitely a value add to get through those hurdles with your team and expertise to work with the government, the education campaign for the neighborhood. uh I like how you said the nimbyism. That's the not in my backyard for those who aren't familiar with that. And yeah, that makes a lot of sense. So super cool. So 0 to break ground to 14 number of phases. And then there's you do the loan to cost loan. Loan to cost, that includes from the bank, that's all things construction as well, right?
yeah, that's total project cost. Yeah, so
Okay.
like I said, we're typically getting 65% loan to cost
Mhm.
financing, and yeah, that if you just take the total project cost, our debt would be 65% of that.
Cool. Raising the rest, and then your team goes in. GP team adds a little bit as well to get the deal whole.
Hmm.
And then the I think you said the upper or lower double digits for the cash on cash return.
That's right.
Cool. So
Yeah, and then at exit we would hope to generate IRRs in the mid to low 20s for the investor. So once
outstanding.
that the cash on cash is high single digit, low double digit, and then by the time we sell the asset, we would hope that the investor's generating or that we're generating a mid to low 20s return.
Got it. So you actually refinance out of the construction loan after it's stabilized, right?
We oftentimes do, yeah, and in fact, that's exactly what we did with our community in Tulsa, which is the first one we built that's stabilized, and we're making distributions on that now. Yeah, we refinanced it. We ended up we looked at agency, so kind of Fannie Freddie
Hmm.
kind of debt, but then there's also a lot of life cos out there that will provide financing for this kind of fixed rate financing. Ultimately, we went with actually a credit union that offered the
Oh,
same
cool.
thing at some attractive terms. So, yeah, that's typically the plan is to refinance out of that construction debt. Now, and there's a chance if we feel like the market's right, we'll sell earlier at stabilization. Maybe that happens at the end of 3 years, but
Hmm.
in today's market right now, in today's present interest rate environment, we didn't feel like that was the prudent decision for the investors. We felt like we wanted to, continue to hold and maybe wait for interest rates to come down a little bit and get to a better environment to sell.
Got it. Yeah, key point there that you're paying attention to the market, so when it might be good to exit. I mean,
Yeah.
that's asset management all around, right? And so is that that 3-year mark after like the last phase has been completed, or where is that? How are you counting that 3-year mark?
Yeah, that's from the point that we break ground, right?
Okay,
That
got
would
it.
be kinda from the day we put a shovel in the ground 3 years later, we would,
Wow.
be looking at that.
Got it. So in other words, just to think about the timeline there, it would be from, day 0, breaking ground to the last phase done, something like it would like 24-ish months or so,
Yeah,
right?
23, 24 months is when we would hope to be done with construction, yeah. Yeah,
Got
and
it.
have
And
the
then
last home, delivered and have that construction be done and get the contractors off the
yep.
site.
And then be pre-leasing, leasing all the way through. And when would investors, I'm leading the conversation to, when would investors start to see their return to when, their initial distribution to that exit? Because it sounds like that is actually the exit is typically pretty close to after the initial distributions, huh?
Well, it depends. Like I said, our first community in Tulsa, in that month, call it 30 to 36 range, that's when we're going to start making distributions. And then the base business plan is to continue to hold for another 2.5 years, continue making distributions, and then look to exit at the end of year five.
Got it.
So
Right.
that's our base plan. Now, yeah, there depending on the market, there might be an opportunity to do that earlier, to sell it earlier, where we think, hey,
Mhm.
this is a good time to sell, and we can generate that target return earlier. But I would say our base case is to make distributions for 2.5 years and then sell.
Okay, awesome. Makes sense. Makes sense. I was just curious about some of the optionality of the timelines and how you're paying attention to things. And so, given that you're always paying attention to, market, what's going on, market the dynamics, how do you guys go about mitigating risks for for the BTR investment itself?
Yeah, sure, great question. So big thing is construction, right? And making sure you pick a great general contractor. Make sure you've got good protections in that contract with a guaranteed max price contract where what your total cost is going to be, and you've got you're holding them to a timeline because we want on time on budget, right? That's the
Hmm.
goal.
Oh yeah.
So we're working hard to mitigate that. I think just by having a good, capable, competent team who's got great experience doing this, being able to manage that construction project. We've got great project managers that are experienced at this. That's a big part of it, right? We've done 5 of these already, built them, we manage them, so that experience, I think, in and of itself, helps us mitigate risk certainly. And then the experience, to lease it up and to get these things full and to really start generating y- distributions and yield for that investor is important. So those are some of the ways that we mitigate risk, I think.
Yeah, good point. Coming back to that too, you guys do development, and the Trullo Homes is the residential facing side, and so let's talk a little bit about some of the properties that have been you have or you're managing right now. It sounds like you have some data, right? Well, at least 5 different properties, and we'll talk more about
Yeah.
some of them coming
Yeah,
soon.
that's
But
right. Yeah, we have five communities, and I mentioned our first community in Tulsa, fully stabilized. We're making distributions. That's been a great kind of case study for us in terms of giving us even more conviction around what we're doing. It leased up faster than we projected. Occupancy's been better. The operating margin has been better. Rents have been 20% higher than we underwrote. So it's outperformed underwriting kind of all the way around. Obviously, now interest rates have been higher than we projected. So we didn't get that one just right. But I think we've been able to compensate through the fact that we've been better on underwriting in all the other areas. And so overall, it's been yeah, really a great success. And then we've got our community in Oklahoma City is about 85% leased. So we're still leasing up there, but done with construction. Kansas City has really performed great for us, about 55% leased. That's been a really good lease up for us. And then we've just kind of kicked off our lease up in Indianapolis. We've got
Right.
two phases there. We're about 10 to 15% leased, and then Bentonville's kind of right behind that. We're doing pre-leasing. About to get our first phase in Bentonville. So
Awesome.
and still, still constructing there. We're still building in Bentonville. We're still building in Indy and in KC. So
Yeah, and you have some that's yeah, quite a few in the pipeline there certainly. And you have a couple more, one that's in I'm excited. I mean, I want to go check out that you have going on in Waco, right? That's just about an hour north of me here in Austin. Um that's it looked like a pretty cool location having a look. We're talking about where these places, sit too. And this one, it looks like it's just behind like this whole, center. There's like a Top Golf. There's like Cinemark. There's, a movie theater. There's a, like, I see places for like all the usual suspects, the Chick-fil-A, the Denny's, Burger King, IHOP, all those kind of things. So very close and kind of embedded, right? So how's that one going?
yeah, that's a site that we own that's shovel ready. It is we love that Waco market. You're halfway between Austin and Dallas. It's experienced some great growth. A manufacturing and logistics center, just given its location.
Hmm.
Like a strong defense industry there, strong healthcare. Obviously, a Baylor University there. That's a
Hmm.
big driver. They're the largest employer in Waco. So yeah, love the market. And then we found a site there. Somebody brought it to us there, and it's we felt like it was the best built to rent site in Waco. You're 2.5 miles south of downtown, as you mentioned. A lot of kind of walkable retail,
Yeah.
dining, entertainment options with
Hmm.
Top Golf and Cinemark and a lot of the things that are just kind of right there already built. So we felt like it was a great location. I think in terms of demographics, you're going to see a lot of the same folks that love our Trullo communities, but I think you'll also see a pretty good student population there, just given the fact that it's 3 miles from Baylor's campus. So,
Yeah.
yeah, we're excited about that project. I think it's going to be a really good one.
Yeah, it's a great point too, right? We talked a little about who the typical residents are, but you're talking about really the mix of the market there as well. People that don't want to be in the types of apartments and want to have a little bit of their own. And in a lot of ways, a two bedroom type of place might work well for that. The students or even local workforce who want that type of place as well. Do you see, just come back to that a little bit, do you see, I don't know what you have on top of your head here, but how would you sort of classify the type of residents that you would have in the communities? Are they, mostly like mid late 20s, early 30s, or that senior? Do you find senior type of demographics in these communities as well?
Yeah, I think it varies by community, in terms of which one's the greatest, but and by market. But I would say, yeah, you're still seeing both ends of that barbell, right? It's the young professionals transitioning out of apartments, and it's the empty nesters that are really looking for something that they don't have to maintain anymore. They've got on-site maintenance. They can, have flexibility and nice high-end finishes. So those we're always seeing those two ends of the spectrum. Now, I mentioned Waco as an example. That there's a student population there. We haven't made a big push into student living, if you will, or
Hmm.
specifically focusing on markets with the university. But Waco just happens to have that,
Yeah.
and it's got a lot of other things going for it, which is kind of what brought us there. But
Yeah.
that's something that's unique. So, and then I think you've got all different kind of folks in between. A lot of people in transition. We see um, you know, single parent homes. A lot of people, maybe you got kids that are looking to access a school system. So we see
Hmm.
that as well. But it's those two big ends of the barbell that I mentioned that are typically showing up the largest.
Yeah, good call. Definitely depends on the market itself for the mix, but having a mix for the market obviously helps in general. So, being sort of conscious of your time here, let's move a little bit to a rapid fire perspective. is, we talked about a little bit for the investor returns, a lot about the model to wrap our head around. It's not, for the listeners, so it's not so much a black box, but how does this thing work? How does it operate? How do we think about the markets? Why is it a good fit? And is it a good asset to, invest in, right? But let's talk a little bit about, you know, what types and when we think about a portfolio perspective for the investor, what kind of investor you think is the right one to invest in these types of projects with you?
Yeah, I think I think individual investors that are looking for real estate exposure that like the return profile because frankly it's development. The nice thing about it, it's a high return profile, right? You're talking about mid to low 20s IRRs. That those are strong numbers and hard to find those returns. I think so.
Mhm.
I think folks that are attracted to that, there's a cash flow component here. Now, yes, you got to wait 2.5 to 3 years to really get into that, but once we're there, you start getting those distributions. So I think I've talked to a lot of investors. Some have invested in value add multi, and
Mhm.
they're used to that. But hey, that's a little bit lower return profile, and I think there's some pressures in that business that we've experienced in the last couple of years here. That a lot of investors we've talked to have said, "Hey, look, I'm trying to slow down on value add multi." So we think this is a great alternative for folks in a emerging asset class that has a lot of tailwinds and a lot of demand there. And I would argue, hey, the ability to grow rents in a greater way than you
Yeah.
have in traditional multifamily, and you've got stickier tenants. Our residents in Trullo communities stay about twice as long as folks that stay in traditional apartments. So that's another great benefit of this asset class.
Yeah, yeah, great points. And I remember one of the things you were talking about too was that even on the retention, you guys are getting some really good increases as well, right?
Yeah, yeah,
Yeah.
yeah. We've seen that. Yeah, but yeah, once people get there and live in one of our Trullo communities, they tend to want to stay.
Yeah, outstanding. I mean, that says a lot about just the community in general. So, fitting the profile, it's totally up to an individual thing. But like you were talking about, Ryan, as this fits, you're going to have those IRRs. You're going to have a more balanced out portfolio if you do have some cash flow as well, and you want to augment this. We're even start with this too, based on your own needs and would want. So, we've covered a lot of really good stuff here. So focusing on the future for additional opportunities of BTR sector to close us out. What are you excited about?
Yeah, yeah. We've got two shovel ready projects. We talked about Waco. We have another one in Centerville, Ohio. We've got a site that we love up there. That's kind of between Cincinnati and Dayton. Really strong submarket. Actually, the highest median incomes of any market that we've invested in to date. We're building one in Indianapolis, and we've got a great uh, builder partner there who called Leo Brown Group that we've approached the upper Midwest with. We're 50-50 in the GP
Yeah.
there. And so they do a really good job of building for us and give us some local presence in that market, really know that area. So we've got that project coming down the pipeline that'll be probably coming next. And then, the Waco project we discussed kind of right behind it. So we're excited about both those two developments, and then we've got another site that we own in Kansas City that will probably be coming along later. So yeah, a lot of stuff in the pipeline, and excited about the business we've built and the Trullo communities that we're already building and operating, and look forward to trying to bring this product to more residents out there, provide the market with more housing options, and help address some of the fundamental housing shortage we've got, and the lack of home affordability, and we're also excited to and always working hard for our shareholders and investors to deliver a great result and a great outcome. So yeah, those are
Yeah.
the things that I'm excited about.
Yeah, a lot to look forward to, and I am excited. I do really want to check out that Waco property as it goes. So, awesome! Congratulations to all of your guys' success. Great to hear, the heart of giving back to the community as well. Certainly in mind. And I love to close out with this one since this question here, last question for the day, is because you gave a little bit about your experience having real estate, oil and gas, different partners. There's a wealth of knowledge here. So, as we close out, the question is, what would you tell yourself, when you were an early stage investor? What do you wish that you knew when you had first started investing?
Oh, I mean, I think I touched on it earlier, but I was guilty early on of like you try to just do everything, right? You're trying to be the Swiss Army knife. I'm gonna I can handle everything. I'm the best at everything. You end up stretching yourself too thin. I
Yeah.
think what I've learned over time is having great partners, understanding what are my strengths, what am I good at, and hey, let me focus there, and then let me find great partners, people that I can be in business with that can complement that and handle other parts of the business. So for me, it took me a while to learn that lesson, but would have been nice to have learned it earlier. But I'm glad I know it now.
Outstanding. Ryan, thank you so much. I will make sure all of the contact info for you and team Red River is in the show notes and other places. Is there anything in particular that you want to say before we close?
No, I think we've covered a lot here. I appreciate it, Steven. It's been great to be with you. I've really enjoyed the conversation. Great questions, and yeah, look forward to talking again soon.
Likewise. Thank you, sir.
Take care.
Thanks for joining us on another episode of Path to Passive. We love connecting with our listeners and those on the path to architecting their wealth and improving their lives. Feel free to let us know what topics you'd like to see in future episodes. Get in touch with us through email or Instagram. See you next week for a new episode.